we still remain constructive on the market. I mean, we had expected earnings to sort of be the stabilizer in the face of higher bond yields. And it's been a tough earnings season so far, not because companies are missing expectations, they're actually beating expectations, but the stock market response has been more muted and even negative. And those that have had weaker outlook on guidance have actually been punished in this market environment. And so what that is telling us is that the bar is high. And of course, those higher bond yields are also challenging the relative attractiveness of the equity market. But we do think that the market is hitting some key technical levels. You're now seeing the S&P 500 trade under that 200-day moving average and flirting with correction territory. So we think when we get into the back half of the earnings season, that hopefully that would act like a stabilizer and companies will continue to beat. We do think that the outlook for earnings has improved just given the strength of the economy. And so essentially we are buyers on this weakness.
Ah, nice. So, I mean, as we think about these markets here, I mean, I guess, are you at the point where you think we're at peak rates here and that the next move, whenever it does come, will be lower? Or are you still have some Federal Reserve risk in your outlook?
You know, next week we'll see what the Fed messaging is. We do think that the Fed is done hiking. I mean, I think it's widely expected at this point that the Fed will remain on hold next week. We did hear some of that being echoed by several of the Fed speakers ahead of the blackout period. Some might say that November is a skip, but we think that the hiking cycle ended back in July. I mean, we all know that financial conditions have tightened quite a bit and the long end of the curve have moved up, and it's doing exactly what the Fed had hoped to do. So that transition mechanism of tighter monetary policy is happening. And as we heard Chairman Powell say last week, there could be even more in the pipeline, just given the fact that the Fed has raised interest rate so quickly over the last year. And so we think that the hiking cycle is done. In terms of the outlook for sort of the 10-year Treasury note and the yield on that, reality is bond market volatility remains so high. And so it's difficult to know if we've seen a peak on the long end of the curve. We could see it test 5% again, but we do think that once the Fed is done hiking and that's clear and economic growth slows, we expect that the 10-year to come back towards 3.5% by the time we get to mid next year.
Wow. So you think, I guess investors, certainly domestic investors, are buying these bonds, but it doesn't look like there's any demand internationally, even at 5%. What pushes us back down? Do we get our deficits and debt under control as a country, or just the slowdown in the economy?
It's more the slowdown of the economy. We do know that there's a bit of a term premium that's being built in on the long end of the curve, just given the concerns around the deficit. So what we really think is going to drive bond yields lower is going to be a slower economy, inflation abated. I mean, you saw today in terms of PCE, yes, headline did surprise a little bit to the upside, but more importantly, core PCE continues to moderate. I mean, you have year over year core PCE at 3.7%. That's right in line where the Fed had expected it to be at the end of the year. And so we are ahead of trend. And we think that that core PCE is going to come down even by another 25 basis points by the time we get to the end of the year. And so that's partly why we think the Fed is done hiking, and that should help to sort of stabilize bond yields and push them low. And we are looking for a period of sub-trend economic growth. We don't think that the momentum that we've seen in the third quarter is going to continue at the same pace. And so we think that GDP would come in under 2% by the time we get to the year end and into next year. And that's what will help bring down bond yields.